calling this fortunes will be made and fortunes will certainly be lost, because timing is going to become everything. Let me just talk about this for just a second. Here we are in April of 2023. Our timing model is showing that we probably are going to start seeing evidence of a slowdown in the real estate market by probably end of the second quarter, entering into the third quarter. Now we're starting to see some pending home sales slow down. We are seeing the builders selling the living daylights out of their inventory. Those guys are scared to death. They're going to make deals like nobody's business. They're buying rates down. They're giving concessions left and right because they are going to have problems with their financing. And of course, they don't want to have these as specs. This is how you go out of business as a builder. This is not really, really good. We're seeing problems in a lot of the major cities. We just saw PIMCO let go of 7 buildings for a total of $1.7 billion. They didn't want to refinance or couldn't refinance their commercial towers in one of their REITs. And of course, we're seeing this around town. But let me just tell you that in a lot of these cities, if you're starting to see commercial leave, retail space leave, you're starting to have office workers not coming. Well, you're going to have vacancy in these towers. And if you were getting $100 million worth of rent, and now you're only getting $70 million worth of rent, that means that building is not worth as much as you paid for it. And the lenders don't refinance that. So lots of problems. Let's go into these and see what that's going to be like. And let's just talk about some of that, because we've got some really interesting times coming to us right now. Now, there is leading economic indicators that are showing that the economy is falling into recession. We've gone into beyond watch into warning. Whenever we cross that warning line, we get a recession. And I think a recession is coming. I don't think it's going to be a soft landing recession. I think it's going to be a pretty brutal recession. You know, we've got liquidity issues. We've got asset issues. We have the bond markets. Of course, a lot of these mortgage-backed securities and a lot of the banks have mortgages that are priced at 3.5%. Now we're in a 5 to 6.5% market. Well, the value of those properties go down. The value of those mortgages go down. In Europe, of course, the government's made the pension plans by below zero mortgages, negative rated mortgages. And now they went from negative below zero, -1, -0.5, whatever they were, to 5. Well, those bonds that they bought from the government aren't worth anywhere near as much. I mean, I'm hearing that the pension funds have lost 60, 70, 80% of their value. And of course, baby boomers like me are just getting to the point where we're starting to take money out of our pensions. And so the burn rate's going to go up, and they don't have any income coming in. So this is just a setup for a major problem, and we're entering into a recession on top of that. So I don't see how we could have a soft landing. This appears to me to be a pretty hard landing, and I'm going to tell you that it looks to me like places at north. I think Chicago's in trouble. We just got this from the Philadelphia Fed. Not only are they below zero, they're at 31. They're rivaling the depth of the 2008 recession, and we're just getting started. We're just now getting started in what can be a pretty tough recession. So if they're at -31 now, and it would gotten as low as -35 during 2008, and we're just starting, this thing could really get some legs and really start going bad. So I bring this to your attention because if you have investment properties in Philadelphia, you need to start paying attention. You know, same thing that we're seeing in Kansas City is having some problems, and the Empire State's having problems. So a lot of these cities are struggling. Let me go to my next slide, see if we can make any heads or tails out of that one. And we've talked to this before. So I've added Chicago as at the top of my list. I think Chicago may very well be on its way to being a failed city. You saw Citadel Investments leave. We're starting to see Walmart leave, Target leave. Next is going to be, of course, CVS and Walgreens. All these places are concerned with crime and shoplifting. Chicago just had a couple weeks of terrible rioting for young children in their teens that came down and caused havoc, broke windows, assaulted tourists and people walking on the street, broke cars, broke windows. And who's going to want to go down to downtown on a Saturday night when you have children doing this that are just rioting and out of control? That's one of the first stages, when you start getting a failed city. So can Chicago go the way of Baltimore, where they're having problems in their downtown area as well? But of course, Baltimore, people have already left Baltimore. A lot of the retail, you just have boarded up sections. Can Chicago become a Baltimore or Detroit? You bet you it can. So a lot of these cities up north and that are on my watch list. So Milwaukee, Minneapolis, Los Angeles, of course, and we just mentioned the fact that PIMCO on one of the REITs let go of 7 towers because they couldn't make any money. San Francisco, we're hearing horror stories in San Francisco. You just heard that we are having vacancy as high as 35%, 29 plus 6% available in downtown San Francisco. And of course, how do you have a profitable office building with 30% vacant? You can't. So the valuations of these properties drops, and the reason for this is because that they're concerned about crime. And of course, Whole Foods just opened up 1 year ago a flagship Whole Foods, 60,000 square feet of bells and whistles and shiny things. Just an absolutely beautiful store in downtown San Francisco. And they've closed it for crime, and they're concerned for their employees being assaulted on the way to work. So when you see this happening and Walmart's left, CVS is left, Walgreens is left, Target's leaving. So when you have this in a downtown central city, that is going to be a failed city. That means where all the real estate taxes and the sales tax that these stores and office buildings generated aren't going to be there. So it's going to get disseminated out to the real estate of the residential, because the city still needs to run, and it's going to be a downward spiral, because a lot of people aren't going to want to assume that. That's already happening in Seattle. You're going to see that in Seattle, Portland. New York is having problems. New York City, they're having problems with a lot of their towers. New Jersey, Washington D.C., and you just saw the Fed from Philadelphia Fed. We just got their charts looking very, very ominous if you're in any one of those cities, but particularly Chicago. So if you're in those cities, you really need to talk to your investment advisor, find out what your exposure is. You're welcome to call us. There are places in the country now. Real estate, I think, is probably turning over on its cycle, but each one of these is regional. So some regions are going to do way better than others. I mean, if you're looking at Florida, Texas, or Arizona, they're going to do way better than Chicago, Milwaukee, Minneapolis. These cities are in jeopardy. Where you talk about, Phoenix is not. We start talking about going to Miami. What a great city to be looking for opening businesses and doing investment work. So it depends on where you are. A lot of these regions are still doing very, very well in the United States. But if you're in a poorly run city with lots of crime, I think that you're at risk, and you probably need to talk to your financial advisor on that and see what you can do about that. And always do a 1031 exchange. We highly recommend that you do a 1031 exchange. Sell what you can and get into a better one, where if you're not making money in Chicago, you can certainly make money here in Phoenix, Arizona. So let me move to my next slide here, and let's just talk about that. So we've been talking about this ad infinitum that we saw liquidity peak March 2022. The Federal Reserve was still buying mortgage-backed securities, keeping interest rates low in the housing index. But now they're taking $90 billion a month out for over $1 trillion in liquidity. You hear the problem with liquidity everywhere. A lot of these banks just don't have any cash. And of course, you don't have cash and liquidity, you can't lend. And the little bit that you have, you get to be very, very particular who you're going to lend it to. And underwriting gets to be a problem. So if you've got a project and you think it's a good project, but the underwriter doesn't, you're not going to get financed. Now, this is a huge dramatic change from just like a year ago. But for about 5 to 10 years, we had so much liquidity, you could do almost any crazy notion that you had. And that's just not happening anymore. Now, this is my timing model, and I think we're up here. I think we're up getting pretty close to the top. That's called the winner's curse in a lot of others. You may have seen this around. This means that when you buy this, you're buying at the top of the market, because when the cycle completes, it comes down and it retraces from where it was and then starts again. Now, when it starts retracing, this is a fairly quick retracement. That's sometimes called the waterfall effect. A waterfall effect means it drops. It's gonna drop fairly precipitously because there's no bid on it. Financing's bad, business is bad. Buyers don't want to buy, and when there's no bid, prices come down, and that can be a pretty rapid decline. But that leads to having lots and lots of inventory at very, very good prices. It's a generational buying opportunity. You get maybe 1 or 2 chances in your life to do this. Me, I'm going to see 3, so that's kind of unusual. But here it is. It's going to be a generational opportunity, and it's going to be right there. It's going to be staring us in the face here in the next probably 12 to 15 months. We might see that. Now, we've been talking about peaks. So you can see this is a 2005 peak. You can see that clearly designed. There's actually 2 peaks. So once you get to 2 peaks, the first one is when everything's happening, lots of momentum. No one can get enough real estate. Everybody has to have more and more real estate. They're outbidding each other, paying more than what they need to. And that's the first peak. Then it kind of slows down. You drop a little bit. That's what happened here in Phoenix. We dropped about 10.5%. Then you go into the second peak and you recover some of that you've lost. So here in Phoenix, we recovered 5 or 6 or 7%. And that's into the second peak. And that second peak is the final peak. And I think we're forming that second peak right now. And then it's going to retrace all the way down. I think this little piece here is starting to be the second peak, and I think that's forming now. I think you can clearly see it now. I got this morning from Zero Hedge, and it clearly shows that in the pending sales. Now, pending is more of a forward-looking than the sales, because there's a lag between when they're sold and when they're closed, or I should say when they go into escrow and then when they sell, and that's typically 30 or 45 days. So when you look at the pending, you can really see that, it's turned down. And from month over month, we lost 5.2% in pending sales. Now, sales are the first things to go. So you start to see sales come down. And then when the sales and demand, sort of bid on the asset, starts slowing down, prices follow right behind it. Now, Lawrence Yun from the National Association of Realtors came out and said multiple offers are still occurring on about 1/3 of the listings, and 28% of the homes are selling above list price, and they're still getting multiple bids, and that's probably because of the inventory. Now, when you get here to Phoenix, Arizona, we don't have any near the inventory. We're still short of inventory, and it's probably going to remain the same, because if you bought a house, as little as a year ago and closed on it, you probably have a mortgage of 3.5%. That's a very, very comfortable thing to have. And people aren't selling those. If you've got a mortgage between 2.5 and 3.5, they're not coming to market. People aren't changing homes. So that keeps limiting the amount of inventory that we have. And we see that happening. Again, we're looking at more charts. I think this peak is starting to form. This is the second peak may very well have been of February 2023. We'll take a look and see what happens. But regardless, I think by the time we start getting into the end of the second quarter, really into the maybe the third quarter, we're going to see that it's evident that the recession is underway, and we're going to be having problems. So Charles Hugh Smith has done a wonderful job trying to calculate where the prices could go. I agree with him. I think that nationally, we're probably going to see 30 to 35% retracement on price. Maybe we see that in the bigger markets of Florida, Texas, and Arizona. Miami maybe won't trace back as much. Phoenix may not trace back as much. Maybe a little bit. I don't. We could get back 20%, 25%. If it got really, really severe, we could go to 30. Charles Hugh Smith thinks it could go down 60%, going back to really at the beginning of the new cycle. That would be pretty extreme. But in cities like Chicago, that's starting to be failed. I think you could have problems. The people overpaid for Chicago and then have problems with the government in Chicago. Same with Seattle, and San Francisco's already experiencing that. San Diego and Los Angeles. California, 3 million people left California. 3 million Californians. And these people were entrepreneurs, skilled labor, high-tech people, doctors, attorneys, medical people left because it's so hard to do business in California. Taxes are incredibly high, regulations incredibly high, lots of crime. And so they lost 3 million, but they got 2 million of immigrants that came in. So their net was only a million, but they lost a huge tax base. Now here in Phoenix, Arizona, we picked up over $2 billion in tax base. Do you know we had a surplus here in Arizona? Our income tax dropped. So our taxes dropped from 4.6 to 2.5. That's how well we're doing here. And that has a lot to do with the influx of people coming in. But if you're in these cities that we've mentioned, you could very well see a retracement to that, and that would be a problem. And if it is a problem, we're more than happy to talk to you about it, maybe doing some 1031 exchanges, selling investment property in Chicago and buying something here in Maricopa County. These are my numbers. You're welcome to reach me here. I would say talk to your investment advisor. I talked to Michael Pinto this morning. You don't need to be invested 100% of the time. So you can be selective, need to, take a look at what your exposure is. In my asset class, I think that we're more than happy to discuss this with you, see what's good for you, what's not good for you, and we'll help you in any way we can. I'm available. So my very, very best to you. Bye-bye now.